Welcome back to the second part of the Ifrs 9 lecture. And here we are now going to look at the other method of valuation. So in the first part of this lecture, we talked about amortization or amortized cost. And we said for amortized cost, it can apply to your financial asset as well as your financial liability. And for your financial liability, it is a default valuation. So the other method of valuing financial instruments is called fair value. And there is a very definite definition set out for fair value. And it says fair value is the value at which an asset can be exchanged for or a liability settled for in an orderly transaction between two market participants in an arm's length transaction at measurement date. So this means it's basically the price for which you can buy an asset or pay off a debt if nobody did you any favors. It's just the amount that a objective person would charge at a specific time. That's the definition of fair value. As you can imagine, it's very abstract. So there are consequently two questions that arise if you're an accountant and someone tells you, right, we're going to use the fair value valuation. There are two questions that will arise from your side. So the first question you're going to ask is, how do I obtain or how do I calculate a fair value for an instrument? Where do I start? How do I do the math? Then the second question will be, once I know the value, once I know it's worth 1 Rand, 2 Rand, 50 Rand, 50 million Rand, how do I record it in the books of an entity? How do I account for it? What should happen? And I now want to answer these two questions. So we're firstly going to look at how we obtain or calculate fair value. Right, so there are three levels of fair value that can be used to calculate the value or the fair value of an instrument. So level 1, level 2, and level 3, of which level 1 is the best and level 3 is the worst. So let's look at what this means. So for level 1, it says that the fair value of an instrument is determined through the stock exchange. So this requires that an item needs to be listed on a stock exchange. And this is the most accurate fair value valuation that you can find. So for example, think about a company like Vodacom. If you want to know what a Vodacom share is worth, that's a financial instrument. And what will you do? You can just take your phone. You can Google it, go to JSE, look up the value there on the JSE main board, and they will tell you that a Vodacom share, for example, is worth 150 Rand today. So that's level 1. But the con with level 1 is it can only be applied if the item is listed. And not all financial instruments are listed. Some businesses are small private businesses and they still issue equity. They still issue shares and preference shares and ordinary shares. So level 1 is the best, most accurate method to use, but it's not always practical. So the second level now comes in where we have a company that is not listed. And level 2 says we then determine the fair value by comparing this instrument to other similar instruments. But the comparison must be done with an instrument which is listed, right? So as an example, I said, suppose that we have an unlisted pharmacy. And this pharmacy is called Pharma World Pty Limited. So in the name, you can already hear it's a private company. It's not listed. And it requires its shares to be valued. The valuator can now argue that this entity is very much like Dis-Chem, which indeed is a listed company. It can be determined then that the average fair value of a share of Dis-Chem is between 29 Rand 60 and 30 Rand 20. And the valuator can then deduce that the Pharma World share should also fall within that same price category. So you can now imagine the problem that can arise with level 2. And the problem is that the valuator is comparing one type of instrument to a similar but other listed type of instrument. And here we heavily rely on the professional judgment of the valuator. And someone else might come and say, Pharma World is much smaller than Dis-Chem. You can't say that they are the same. You can't use Dis-Chem as a similar instrument, but it might have been another valuator's opinion that this is a good comparison. So that's why this is less reliable than value one, because it or value level one, because it really depends on the valuator and how they interpret this comparison. Right, the last and least popular is the fair value level 3. So for level 3, you have an instrument which cannot be compared to a listed company. So either there is not a listed company like it, or more regularly, there is a listed company like it, but the listed company is 200 times bigger than this little company. So now it's not listed, it's not comparable to a listed company, and now we go to level 3. And for level 3, we use mathematical approaches to try and estimate the fair value of this financial instrument. So as you can think, it's already highly subjective, and it is considered to be the least accurate way of determining a fair value price. So what are the techniques that we can use? So there are 3 techniques. There's a cost approach, an income approach, and a market approach. So the cost approach will mostly be applied if the person who wants to evaluate the instrument is interested in buying it, right? Then they will use the cost approach. So if you are buying the financial instrument, if you're buying the debenture, buying the share, then you have to determine how much it will cost to replace this instrument. So what else can you buy also with this money? That's one of the approaches. So they need to tell you, we are selling the shares of this little private company for 50 Rand, and then you need to think, is this really going to be worth your while? Then there's an income approach, right? So this is the approach where you decide that you are going to take the future cash flows and you are going to discount it to a present value. And in financial management, this is referred to as free cash flow method. And what you will typically do is you will estimate dividends, and you will say, from year 1 to year 5, I will get a dividend of 200 Rand every year. And then that dividend is then discounted back to a present value at the weighted average cost of capital for that company. And that is your income approach. And then you have a market approach, which is similar to the cost approach, but that will be from the perspective of the issuer, where they ask how much would the market offer. So the cost approach will be from the person who buys it, the purchaser, who says, what does it cost me, right? The market approach is from the issuer, which says, how much will the market pay for this instrument? Is there a demand? Are they interested? Do they want to invest in it? And it will be difficult with a small company to determine, what the market will pay for it, because where are you going to find people, objective people who know about your business, to ask them for a valuation or how much they'd be willing to pay? The people that you're going to ask will be either your friends or your family or your associates or people that you know, and your friends and family might give you positive feedback and say, oh, we love your company, we'll pay a lot for a share. And whereas people who dislike you might say, oh no, we'll never invest in this company. So it's very difficult to find an objective valuation in terms of the market if it's a small business that not a lot of people know about. But these are the 3 levels, level 1, 2, and 3. And that is how fair value can be determined. Moving on, we had a second question. So if I've determined my fair value, so I've used level 1, 2, or 3, how do I now, what are the practical implications for capturing this transaction? So for fair value, we have 2 approaches. And we need to go and consider now, importantly, if this is a financial asset or a financial liability. So if it's a financial asset, there are 2 options in terms of fair value valuations. So there can be fair value through profit or loss and fair value through OCI. That's what we can have if it's a financial asset, that type of instrument. So To use profit or loss as a method of capturing the data, of recording it, the financial asset should be held for trading in the ordinary course of business. So what does this mean? It means that it is my business to trade in financial assets. So ultimately, these financial assets will be my inventory. And this method can be used, for example, if you're a broker, because now you are buying shares of a company, you keep it as a financial asset, and then you are selling it in the ordinary. That's how you make money. It's the ordinary course of your business. You buy the shares, and those shares will be your inventory, and you sell them again. As soon as they grow a little bit, you sell them tomorrow, 3 days from now, 5 days from now, and you sell them and you make money. And that is your main business. That's how you make profit. If that is what you do, if you're a broker or for example, lawyers can also do this, that would be profit and loss. If you have a fair value through OCI, it means that the financial asset is held to obtain returns and sell the investment only from time to time to speculate. So if you book it through OCI, it means that you have a main business, and selling financial assets, buying and selling, is just a little sideline gig. So let's say you have a business like it makes furniture. You have a very big furniture store. That's your main business. But on the sideline, you also buy financial assets of other, let's say, furniture stores, grocery stores, technology stores, or whatever. You buy company shares and then you sell it. And if you see that the value is growing, you speculate with it. But mostly you just buy it and you keep it and you get returns, you get your dividend, you get your interest. Then that is through OCI. So if it's not the main business, but you do it on the sideline just to make a little bit more money, then it would be through OCI. So I put an example here of the financial asset, and I said, suppose that BB Limited purchases 1,000 ordinary shares in CC Limited on 1 June 2021 at 35 Rand per share. On 31st December 2021, the fair value has now increased to 42 Rand. So what will happen if this is a financial asset through profit or loss? So if it's speculated with as the main business, then we're going to recognize the financial asset, and we say we pay for it 1,000 of them times 35 Rand. And then at year end, the value increases. So it's 42 minus 35 times the 1,000. And now this is basically identical to what we do with investment property. But instead of investment property, we say financial asset. And we say it's a fair value adjustment through profit or loss, a fair value adjustment income, or a fair value adjustment expense. Suppose that it was through OCI. We take the same example. It's a financial asset, but it's through OCI. What will the entries look like then? So you will still recognize your financial asset and put the money or take the money out of the account when you buy it. And then when there's an adjustment, you will still measure the fair value adjustment, but you will put it in a market-to-market reserve OCI. So there's no fair value adjustment income or fair value adjustment expense. It's now OCI. That account is called market-to-market reserve. So that's the difference between OCI and profit or loss. Let's talk about what happens with a financial liability. So with a financial liability, the practical implications for fair value is that you can only value it at fair value if it is held for trading. So then you take it through profit or loss. So for financial liabilities overall, the default is amortized cost, but if it's held for trading, then it is taken fair value through profit or loss. I've put an example here. I said, suppose DD Limited sells 2,000 debentures to EE Limited at 25 Rand per debenture on 1 July 2021. The debentures were held for sale, and on 31st December, the fair value of such a debt should be 55,000. So now you can see that the debt that we recognized was 2,000 times 25, which was 50,000, but now needs to be adjusted. The debt should be 55. So we increase it with 5,000, and the debit entry that goes with that credit is a fair value adjustment expense, because again, it's through profit or loss. Had it been the other way around, it would be you debit the financial liability and you credit fair value adjustment income, profit or loss. So through profit or loss, it's a fair value adjustment expense or income. Through OCI, it's market to market, but with financial liabilities, you can never have fair value through OCI. The only option with financial liabilities is fair value through profit or loss. However, it can go through OCI if it's a financial asset valuation. Right, the last part, I just want to talk about initial measurement. So initial measurement is basically when we have a transaction cost that goes with our purchasing of or our issuance of a financial instrument. So you will often find when you buy a financial instrument, there's a fee that you have to pay. There's a lawyer fee, a broker fee that you have to pay. That is really interesting. And the question was then with Ifrs 9, but how do I treat this transaction cost? So if you have to pay an additional fee, it's like a service fee, a help fee, a broker fee, so that you can obtain this asset or issue this liability. How do you treat that fee, that transaction cost? They call it a transaction cost. And Ifrs 9 has set out certain rules of how this transaction cost should be handled. So if it is a financial instrument, that is valued through fair value, profit or loss, it should be treated, the transaction cost should be treated as a separate expense. If the financial instrument goes through fair value OCI, we take the fair value plus the transaction cost as an initial cost. If it's a financial asset through amortization cost, we take the present value plus the transaction cost. If it's a financial liability that is valued through amortized cost, it's the present value minus the transaction cost. All right, so this might seem a bit abstract, so I have an example. So let's say we have XX Limited and they buy 10,000 ordinary shares of YY Limited at 5 Rand per share. The initial transaction cost is 3,000. The shares have a fair value of 5 Rand 50 at year end. The shares are held at fair value through OCI. How would XX account for the shares? So they buy it. So this is a financial asset. How do I know it's an asset? Because it's purchased, it's bought. If it's an XX issued the share, then it would have been a financial liability. So sometimes we don't have an accounting problem. We have a reading problem. So make sure if you see that the entity buys the instrument, that instrument is an asset. If you see that the entity issues the instrument, then that is a financial liability. Okay, for the solution, we're then going to say the financial asset, when on the initial recognition, we're going to say it's then through OCI. So we're going to take 5 times 10,000 plus the 3,000 transaction cost. And that means that the initial value at which we recognize it is now 53,000. There's also a valuation at year end, and that was 5 Rand 50. So that's 55 minus 53,000. It's an increase of 2,000, and we put it against market to market reserve. So what is important here is to notice how the transaction cost there was added. And there's the rule. It says it's a financial instrument, fair value OCI. So you take the fair value plus the transaction cost when you initially recognize it on the date that you buy it or the date that it is issued. Right. So there's the market to market reserve because it's OCI, and that is the journals that you would have done there. In the second example, I said, suppose that TJ Limited issues 5,012% debentures at 500 Rand each. Debentures mature after 3 years. The initial transaction cost is 20,000. How would TJ account for the debentures? So now, again, we have to read. TJ issues. So this is a financial liability. If it is purchase or buy, it's a financial asset. And now they want to know how this transaction cost will be treated, that 20,000. So what is the default treatment of a financial liability? There's two. There's amortized cost. So that's the default. And then there is, if it's held for sale, it's fair value profit or loss. But here they don't say it's held for sale, so it must be the default method. So we must use amortized cost. Right, the solution we're going to type into our calculators. 5,000 times 500 for the future value. It's for 3 years. For the present value, we're going to say 5,000 times 500 minus 20,000. So please note how the transaction cost is deducted there. And I type my present value into my calculator as a negative. Otherwise, it's going to say error when you want to calculate the outstanding figure. Let's say the effective rate or the years or whatever. So you need to type it negatively. Then the payment is the future value times the 12%. And if I say compute the interest rate, the effective interest is 12.34%. How do I account for this? I'm going to take, for initial recognition, I'm going to post the financial liability at the present value. Then for amort 1, I'm going to recognize my interest expense. And I'm going to have my bank, which is the payment. And for financial liability, this is going to be my balance. So if I look under amort 1, after typing this, that's the interest that you will see. All right, so I just wanted to bring that under your attention, and I'm going to again say the way that you operate your financial calculator is going to be very, very important. So I'm going to follow this up with an example, and there's going to be, I think on that question, there's 10 random examples, and I'm going to post that video, or I'm going to say, please look at that combo. I think I called it combo of examples. And that's the one I would look at first, because it makes sure that you understand how the operation of your calculator works. And then thereafter, we will go to the journals and do journal entries. But first, we need to make sure you understand the calculator. So please make sure that you watch the combination questions first. So I will see you in that example. Thank you for watching the 2-part of this video, and I will see you then in the first video explanation of the combination questions.